The long-term investing world is obsessed with economic moats. I'm obsessed with economic moats. It's easy to talk about investing in businesses with wide economic moats, but what does that really mean? One thing is certain, however, if a business does not have a wide economic moat, that business is a loser. So how do we go about identifying the economic moat? Welcome to the Quality Investor. Economic moats have both quantitative and qualitative aspects. Of course, we all know about Warren Buffett's famous economic moats, such as Coca-Cola's brand and Apple's iPhone. And those are both largely qualitative. Coca-Cola, of course, has built its brand over a century, and it has a very positive share of mind in the minds of its consumers. And Apple's iPhone, on the other hand, it has almost become an extension of its users. It is unimaginable to go through life without one nowadays. But before we dig deeper, please remember to hit that like button and subscribe to the channel so you can stay up to date on all the quality businesses in the market. For both Coca-Cola and Apple, it seems obvious to notice these now. But how do we go about identifying these moats before they become massive? Is there a way to quantitatively identify these businesses based on their financials? What sort of traits do wide economic moat businesses share that we can use to identify businesses that are growing their economic moat? This is something I've actually been working on now for the last few months. What I'm trying to do is score businesses based on financial metrics that I think are relevant to wide economic moats. And from there, I want to use those scores to dive deeper into businesses to assess the qualitative aspects of their economic moats. And like with any system designed to assess a population, there are going to be outliers. However, I think we can learn just as much from these outliers as we can from the businesses that don't deviate from the norm. Now, I didn't pull these metrics out of nowhere. I cobbled all of these metrics together based on various books and other sources from investors that I admire. So let's take a look at some of these metrics and assess how they're relevant to an economic moat. This graphic entitled How Warren Buffett Selects Companies is by Q Compounding from X. It's a compilation of various metrics and sourced from the book Warren Buffett and the Interpretation of Financial Statements. I've read the book myself and I do recommend it. It's an excellent intro to how to interpret financial statements from an investor's perspective. It's good, especially if you're a beginner. Anyways, there's a few key metrics that I'm looking at from an economic moat perspective. The ones I think are key are gross margin, SG&A margin, interest margin, and the CapEx margin. Each of these, of course, are important in their own way. However, let's think about gross margin. Gross margin essentially is how much profit is made from every unit sold. You have a unit of something, it costs X amount of dollars to make that unit. The difference between what you sell it for and what it costs to make, that's your profit. So you want to get this gross margin as high as possible, meaning your cost of goods sold is as low as possible. A high margin business, for example, is a business that sells services because they have very little costs in the production of what it is they're selling. A low margin business would be a retail business where they have a very high cost of procuring inventory to sell. The next is SG&A margin. And notice here, it's SG&A over gross profit. So once you have your gross profit, you have to pay out all of your other expenses. That's your overhead. The largest component of that overhead is SG&A, or selling, general, and administrative expenses. This is things like your marketing expenses, rent on any sort of buildings you may use, utility costs, anything not directly associated with the selling of a product. Interest margin is another important metric in assessing an economic moat. This is interest over your operating income. So after all of your operations are taken care of, whatever you have left is your operating income. You have to pay your interest from that amount. This number here speaks to a company's ability to service its debt. And this is even more important today in a higher interest rate environment. Any sort of new debt a business takes on, they're going to be paying a higher interest rate on that debt than they were, say, 5 years ago. And finally, from this list, we're looking at your CapEx margin. This is capital expenditures over net income. So why net income? After you pay your interest and then you pay your taxes, what's left over is, of course, your net income. So any reinvestment back into the business can only come once you pay all operational and non-operational ongoing expenses. Operational, of course, is all the core expenses, your cost of goods sold, your SG&A. Your non-operational is your interest and taxes, although some would argue taxes are operational. However, you can only reinvest back into the business after all of those are paid. Furthermore, a business that has a lot of capital to maintain, meaning they have a very large amount of property, plant, and equipment, maybe leases that they have to service, a large tangible set of assets that have to have ongoing expenses to maintain, they're going to have a higher capital expenditure just to maintain that. On top of that, to grow the business, they're going to have to pay capital expenditure, reinvesting back into the business, and more property, plant, and equipment. Those, of course, are all your CapEx, and that ratio of CapEx over net income indicates how capital intensive a business is. One thing I always talk about on this channel is investing in capital light businesses. What that means is a CapEx to net income ratio that's very low. Here's another graphic from that same X account, Q compounding. The one thing I wanted to point out here is number 4. Great capital allocation. This is ROIC and ROCE. These metrics are similar, and what they're measuring is the amount of profit, or really core operating profit, generated from what you have invested into the business itself, into its core operations. ROIC is NOPAT, or net operating profit after taxes, over invested capital. ROCE is return on capital employed. And the calculation I use for that is operating cash flow over capital employed. Capital employed is assets minus current liabilities. So they're measuring similar items, but what this is a proxy for is the quality of management. Essentially, is the management making good capital allocation decisions? The higher these numbers, that means the better the value that's being created by the investments that management is making. There's one more metric I use in how I score these economic moats, which I'll show you here in a second. Here is my initial scorecard. Across the top here, we have gross percent, SG&A percent, interest expense, CapEx expense, FCF conversion, free cash flow conversion, ROIC, and ROCE. And I assign each of these metrics a score of 1 to 5. Before getting into that, let me talk about free cash flow conversion. Free cash flow conversion is how much money a business converts to free cash flow from its net income. So it's free cash flow over net income. The higher it converts into free cash flow, the more money that goes into shareholders' pockets at the end of the day. So the first thing I did is I looked at each of these components individually and I put them into percentiles, 80th, 60th, 40th, and 20th. This is based on the S&P 500. So for gross margin, for example, the 80th percentile of gross margin percent in the S&P 500 is at 66.2%. So the top 100 companies in the S&P 500 have a gross margin above 66%. The bottom 100 companies of the S&P 500 have a gross margin below 26.36%. So if you're in the 80th percentile, you get a score of 5. If you're below the 20th percentile, meaning you're in the 0 to 19th percent, you have a score of 1. And I can look at this in a couple different ways. I have this period down here, 1, 3, 5, and 10. The 5-year period means I'm taking an average of the previous 5 years from the current fiscal period of each business. If I have 10-year checked, that means I'm taking the previous 10 years, that average from the current fiscal year. So you can see the top businesses right now in the S&P 500 here on this chart, the rolling 5-year gross margin percent. Insight has a gross margin percent of 94.35, followed by Autodesk at 90%, and then Cadence Design at 89%. So just scrolling down the list a bit, you can see some of the big names here. Adobe at 87%, MSCI at 82%, MasterCard at 81%, Intuit 81.3%, and then I compile all of those scores together here. Now, this isn't just a straight average. This is actually a weighted average. Through months of testing and trial and error, the weighted averages I came up with that I think closely reflect the true value created in an economic moat are 10% weight to gross margin, 12.5% weight to the CapEx over net income, 17.5% weight to free cash flow conversion, a 5% weight to the SG&A, a 7.5% weight to interest expense, a 22.5% weight to ROIC, and a 25% weight to ROCE. So looking at the percentiles for return on invested capital, for example, you can see the 80th percentile, or the top 100 businesses or in the S&P 500, have at least a 19.39% ROIC. Remember, Warren Buffett's criteria for that was anything above 15%. That would roughly fall into about the 75th percentile. And I think it's fair to say Warren Buffett invests generally in the top 25% of the businesses in the world. Scrolling the list here, you can see some of those businesses: Fortinet, MasterCard, Apple, IDEXX, which is a Terry Smith favorite. The point is, I'm trying to quantify what I believe is the economic moat. Now, that doesn't mean I'm just going to invest in every single one of these companies and call it a day. But this is a starting point for me to further dive into the qualitative aspect of each business. You can see the top businesses here: Intuit, Vertex Pharmaceuticals, Market Access Holdings, Adobe, Cisco, Autodesk, so on. I own a few of these: Adobe, for example, Visa, Fortinet, but there's others that are at the top of this list that I've been waiting to buy, that I want to buy, but I just think they're too expensive. Intuit's a good example. Cadence is another example. However, there's other businesses that I've looked at that I have no desire to buy. Cisco is one. VeriSign's another, because after doing a little bit more research on those businesses, I can't see what is sustaining their economic moat. I just updated this list for all the businesses in my own portfolio. You can see that the economic score for almost every business I own is above a 4, and I'll show you how all of this correlates in a second. If it's below a 4, it doesn't necessarily mean it's bad. In fact, the threshold seems to be about a 3 based on all the data I've compiled. But what is true is that over time, this economic score is growing for these companies. And I'm going to show you what that means. What we're looking at is a rolling score over the last 5 fiscal years for each business. Every business I own has either sustained their score over time, Adobe is a good example here, or they're increasing it over time. Costco, increasing it over time. Fortinet has increased it over time. But these charts down here allow me to see more visually how each of these businesses are performing over time on each of these metrics that I think are very important. So this is a rolling 5-year economic moat score, meaning the fiscal year score for McDonald's of 3.68 is factoring in an average of each of these fiscal years here, all the way up to fiscal year -4, which is 5 years ago. And of course, fiscal year -3 is taking in fiscal years -4, -5, -6, and -7, along with fiscal year -3 as its 5-year average. So I want to reiterate, I'm using this to assess how well a company is performing on these important metrics and if that's going to generate the real returns that I'm looking for in the market. Now, of course, this isn't predicting anything going forward. However, I do believe this shows that if a company is consistently improving on these metrics over time, they are consistently getting a higher and higher return in the market. So let me show you that correlation now. So this chart here on the right, here's that correlation. These are all 500 businesses in the S&P 500 charted with the score on the x-axis and their return on the y-axis. This is their 5-year rolling average score versus their 5-year return on the share price. And I'm using the 5-year return of where their closing price was at the last fiscal year end compared with 5 years prior to that. And you can see here, it's a pretty high correlation between the score and the return. Of course, we have our outliers, which I discussed before, and I'll show you what I think those mean here in a minute. Here on the left-hand side, we have a growth and economic moat score. I showed you all the components of the economic moat score, but I haven't showed you yet what I'm including in the growth score. I'm going to do another breakdown video of what I'm including in my growth score. The point is that these two scores taken together, this is what gives me my total score on this chart. And this is how I'm assessing each of these businesses. This growth, this is again, this 5 years past growth. And I think you'll see here that there's a pretty high correlation between these scores taken together and the share price return. Enphase, for example, 94.64 annual return in the last 5 years. Fortinet, 32.9 annual return in the last 5 years. Of course, Nvidia, the 5th highest scoring on my list, a 76% annual return in the last 5 years. And what you can see is each of these have very high economic moat scores in the 4s, as well as very high growth scores, also in the 4s. But there's also some outliers, like I was saying. But instead of focusing on the outliers that are a good return, let's focus on the ones that don't have such a high return. The 9th highest on my list here is Qualcomm, a 4.2 growth score and a 4.23 economic moat. Yet they have a 9% annual return in the last 5 years. That's below this 10% return line here. And you can see everything that has a 3 and higher tends to have above a 10% return. Of course, you're gonna have a few outliers on the downside as well, Qualcomm being one of those. So why does Qualcomm have such a low return compared to the rest that have pretty significantly high returns? At the very least, they beat the market. This is the importance of diving deeper. What I'm trying to do, like I said initially, is get a quantitative metric that can tell me where to dive in deeper. And once you dive in a little bit deeper to Qualcomm, you'll see that what they do is related to cell phones and whatnot. But that market over the last few years has been either stagnating or kind of contracting a little bit. And Qualcomm's return reflects that. So I want to caution you that this is not a be-all end-all score here, but this is a starting point of where to start looking deeper into businesses. So this looks good on a 5-year basis, but now let's expand it out to a 10-year basis. 10-year, of course, is going to have more data points. Is it even more correlative on a bigger data set? So looking at the 10-year score versus share return here, I think it has an even higher correlation. You can see that all these businesses are even more tightly compact around the trend line. Nvidia here is our lone outlier and also the highest score on the list. And they should be. They're the hottest thing in the market right now. But you can see here, this list now is a lot more reflective of, I would say, the best businesses in the market today. Nvidia, Fortinet, Lam Research, a semiconductor firm, Amazon, Applied Materials, Adobe, Broadcom, Meta, and also on a longer term basis, on a 10-year basis here, you can see hardly anything that is above a 3 had a less than a 10% return, and only a handful, in fact, 2 had less than a 0% return or a negative return. So our goal in investing is to find these businesses, the ones that are above a 3 and above a 10% return. And if we focus on these, I think we're going to get a very good return over the long term. And remember that word, long term. This is a 10-year data set. You're only going to achieve returns like this if you hold for a very long time. This is the chart for my portfolio specifically. You can see here there is a good correlation here between score and return. The one lone outlier here is Coca-Cola. So let's look at Coca-Cola's score. They're on the bottom of my list, a 2.67 for their 10-year score. Decent economic moat, 3.6. But you can see relative to the rest of the list, they have the lowest growth score. In the last 10 years, Coke has been relatively stagnant. In fact, they were kind of falling in about years 10 through 6 before they really started to turn it around a bit in the last 3 to 5 years. But a 3.62 annualized return over the last 10 years for Coca-Cola seems indicative of their very slow growth, 2.1 score. And then on the other end of the spectrum, we have up here, Tesla, 37.8 annualized growth over the last 10 years. Now they have a very low economic moat score, 1.95, but they've also had really good growth, 4. Now I do anticipate a lot of trouble for Tesla in 2024, but as the economy turns around by the end of this year and going into 2025, as well as EV gaining more and more of a market share, we should see Tesla return to some high growth, but it's going to be a rough year for them. And again, the key here is holding long term. You can't be scared off by a bad year here and there. One more thing I thought was interesting is when I look at this on a 3-year basis, just taking into account the last 3 years, of course, there's a bit more of a spread here around the trend line, but let's look at some of the top businesses. Devon Energy, Marathon Oil, Valero Energy, ConocoPhillips, Chevron, ExxonMobil. You're seeing the growth of the energy sector in the last 3 years. Remember, energy is a very cyclical industry, and the last 3 years, a lot of that growth is being captured in this score. So I would say right now, energy is probably at a high point. I don't invest in energy because I don't enjoy the cyclicality of it, but it seems like we're nearing the top or at the top of the cycle in the energy sector. Anyways, this scoring system is something I've been working on now for the last few months, and I'm ready to start displaying it when I do more analysis on my businesses. I'm going to talk about the growth score in another video. But going forward, I'm always trying to understand more and more what drives the share return of a business so we can make smarter and safer decisions in the investments for our portfolios. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.